What's up, everyone? My name's Robbie. This is Robbie Emil, and today we're talking about my favorite sector and sector ETFs to invest in for the second half of 2022. So welcome, everyone. We're talking today about my favorite sector ETFs and picks for the second half of the year. If you're new here, my name's Robbie. Hey, thanks for watching my video. And I talk about ETFs, I talk about stocks, talk about market commentary, what's going on in the bear market, all sorts of things related to investing. And every year for the past couple years, I've done videos on my favorite sectors for the year. Now, I did it going into 2021. I did it going into this year, 2022. And now I'm doing my half of the year kind of update and giving you basically update to what I showed you earlier in this year, what I think is going to happen towards the next part of this year, how I'm positioning myself, and lots of good stuff today. So let's go ahead and let's get into this. Let's just start with a little recap of where we are year to date right now for the different sectors. So year to date performance, energy is the baller of the sector ETFs, the sectors, not sector ETFs. So energy is killing it, 23%. It's up for the year to date. Now, comparatively, utilities is the next one up, and it's negative 1.35%. So obviously, energy is doing a very good job comparatively. Everything else is in the toilet. Nothing's doing well besides that. So when we talk about investing in sectors and sector ETFs and how you want to do it, what I do is I kind of let me show you my portfolio so you understand like why I do this. So this is like a graphical visualization of how I add money into my portfolio. I call this a Jack of all trades portfolio, and I have some different strategies that I use. I have something called Valuations. I have tactical market recreation with sector ETFs. So I'm talking about today. So this is 25% of the money I add into the market, which I usually do quarterly. It goes into this strategy. I also have individual stocks, 35%. Miscellaneous strategies, 10%. I try to keep 5% in cash. So if you kind of look at it here, if you want to see more of a representation, this is how much goes into each of the things that I'm going towards, and tactical is the one we're talking about today. So briefly, let's talk about my thesis for the start of this year when I did my video. And I'll link that video down below if you want to watch it. But basically what I said was, this is one of the charts that I showed, and I showed the correlation of the different sectors during different inflationary regimes. Basically what I'm just saying is, when there's inflation, which sectors do good? And what showed up was that energy and materials were the two that did pretty well. So we know energy has done very well this year, and so that's one of the ones I was overweight. And so let's go back. Let's look here at the different sectors that I was overweight, underweight, and basically neutral on. And so I was overweight on 3 different sectors. RYF was the ETF I used for financials. Energy, XLE is the ETF I used, and then consumer staples. So how did I do with these? I was wrong about energy. I was right about energy. I was wrong about financials. So financials were down about 18, almost 19%, and the S&P 500 over that time period was down almost 15%. So it did about 3 percentage points worse than the S&P 500 on this one. Here on my XLE, I was overweight, and that's energy. So 13.46% gain during this time since I made this video. Versus negative 14.91%. So I did well there. I lost less money than the market on VDC, so my consumer staples, so that was a good one. I was neutral on 4 different ETFs, or 4 different sector ETFs. Healthcare, so I did do better on healthcare. I did better in real estate. I did better in industrials, and I did better in materials. So yes, those were all down, but they were down less than the overall S&P 500. So to me, I actually did better than the market, right? So then we have what I was underweight. Now underweight, I was underweight communications, which definitely did not do a good job, negative 27% versus the market at almost negative 15%. And then VGT, which is technology. Technology also underperformed the S&P 500. It lost more than the S&P 500. Utilities was the one that I didn't see coming. I was not thinking that it would be such a hard, bad bear market this year. So I actually didn't put any money into utilities, and that one didn't work because utilities did do okay since I made that video up about 1%, 1.5%. Consumer discretionary, I got correct. It did not do as well as the S&P 500. Overall, my return for these ETFs were 3.45% better than the S&P 500. So actually, at this point, the money that would have gone into this portfolio actually did better than the S&P 500. So next up, let's talk about where I think things are going to go from here on out. So this is what I think for the next half of this year. This is what I'm looking at. And I do want to show you real quick, the S&P 500, this is how it's made up. This is what it's made up of, right? So you can see the largest part of the S&P 500 is technology. The next largest part is healthcare. Then you have financials and consumer discretionary. They're kind of close. You have communications, right? So when you take a look at the makeup of the different S&P 500 companies, this is what it looks like. And so what we're doing is, I'm saying I'm trying to be tactical. I'm trying to put more money into the different slices of the S&P 500 or the stock market that I think are going to do better, right? I want the better sectors, and I don't want as much as the worst sectors. That's basically what I'm trying to do. Okay, so second half of 2022, this is how I am positioning myself for this next half of the year. So I'm overweight 3 different sectors. So healthcare, energy, materials. These are the different ETFs that I use to invest in these sectors. I made the best ETF videos, so like a bunch of videos on the best ETFs for each of these sectors, which you can see them on my channel. So for example, I made what's the best healthcare ETF, what's the best energy ETF, right? Take a look at those if you want. But these are the different ETFs that I use for my equal weight. And so I have technology, financials, consumer discretionary, communications, consumer staples, and I have utilities here. And then underweight, I have industrials and real estate. Kind of made this a little easier to see in this little graphic here if you want to take a look at this. So healthcare, I'm overweight by 19% versus 15% for the S&P 500. Energy, I'm going to weight it 7% instead of 4.40% for the S&P 500. Materials, I'm going to weight it 4%. Then I'm equal weight technology, financials, consumer discretionary, communications, consumer staples, utilities, and then I am underweight, so industrials, so 2% of my portfolio, industrials instead of 7.8, and we got real estate, 0.9% instead of 2.90%. Okay, so those are my picks for the different sectors for the next part of this year, and including, of course, the ETFs I like to use to get exposure to those. Now, why did I pick some of those sectors? Now, first off, I do like a little sector valuation to start off. And so I don't have a Bloomberg terminal. I don't have access to crazy data. So I scraped the internet. This is what I got. So I was able to find the PE ratio, the average PE ratio over the past 5 years for all the different sectors. And so you see that here. So for example, the communications sector average 5-year PE ratio is 17.7. Currently, it's 12.7. So it's less than the average over the past 5 years. Same thing on this side is the price to sales. Average is 1.8. It's currently 2. It's a bit above the current. Or rather, the current price of sales is above the historical. So what do I do? So as you can see, interestingly, all of the different sectors are actually trading below their PE ratio over the past 5 years, the average PE. So they're all kind of, in a way, you could say maybe potentially cheap. So it doesn't kind of help us. That just means like, well, just invest in the whole S&P 500 because the whole thing is cheap. Okay, well, that's a strategy, of course, we could do. But, I kind of want to get a little further and figure this out. So I ranked them. I said, which sectors are the least expensive compared to the past 5-year PE ratio? So this is what I got. So materials was the number 1 rank for cheapest, right? So it's 56% below its average PE ratio. So that's good. And then, kind of go down here. So we have communications, healthcare, financials. And then we did the same thing with price to sales over here. Put it all together. I go down here. I rank them. So I have all the different rankings that I just kind of mentioned. Materials shows up as the best. So potentially the most, let's say, oversold sector this year, right? Materials has not done very well. A lot of sectors have not. But maybe materials is oversold. So maybe it has potential to come up some. for materials, that's actually the thesis for that specific sector. Now, you have some other ones. So, for example, consumer discretionary. The reason I didn't put consumer discretionary inside my underweight was because I think it's oversold also, right? So when I look at these, part of this is fundamentally what's happening. There's also little things like, what do I think interest rates are going to do to affect the certain sector? Again, I think energy still has some room to run. I think interest rates are going to help energy, generally speaking, because it usually does, as we could see from that first chart I showed you when I started this video. So the other thing here is financials. Now, financials, I've been wrong on this one for most of the year, right? So I thought financials would do better, doing worse. The reason I have financials in the overweight is because maybe right now, because potential recession looming, financials won't do very well. So I was looking at it in terms of inflation and having a bit of interest rate hikes in financials, but maybe it's really not going to work out so much to the advantage if we do have a recession, which is not good, of course, for financial stocks. Real estate, for example, real estate, interest rates going up. I don't love the prospects of real estate right now, given given interest rates going up and affordability of housing and corporate commercial properties and all the different things that involve using debt to pay for properties. Having high interest rates doesn't bode very well for that. Don't love it right now as we have a rising interest rate environment for real estate. Anyway, that's all I got for you. Let's go back real quick and I'll just show you again so you can see one last time what I have here. So again, this is what I have. These are my picks for the year. I'm going to put a link to this spreadsheet down in the description below. You can always come back to this, take a look at how these performed 3 months, 6 months later. You want to see how it goes, just come back to this video, click the link, take a look. And also, by the way, you'll see here where it says if I'm overperforming or underperforming against the S&P 500. Just remember that dividends are not included in this, so there could be impacts on dividends that will make this spreadsheet look a little bit different. So just so you know. Anyway, that's all I have for this video. So I hope you like it. Hit the like button, subscribe to see future videos like this, and please watch another of my videos coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.